Our next guest says equity valuations are still cheap. Live to Melbourne, and George Boubouras, he's head of investment strategy and consulting at UBS Wealth Management Australia. George, thanks for joining us. Let's find out what your view is as to what, with the Fed coming out with those comments in its minutes. Any surprise for you there?
Good morning. No surprise on the Fed comments last night. I know it didn't meet expectations for some analysts, but the reality is what they identified is the truth. The US economy has been expanding from the European credit crunch lows priced in third and fourth quarter last year. The unemployment rate has improved. Labour market conditions are improving from a low base, that is true, and the unemployment rate is still too high, that is true. But there's an awful lot of liquidity in there, and the reality is European stimulus is effectively funded by the US anyway. So there's a form of QE 2.5 anyway going through the US system, going from the US system IMF into Europe. So there's a lot of stimulation there, and the world's #1 economy has been expanding. The earnings on the S&P 500 are reflecting that, because those earnings are reflecting the growth premium of the emerging world, which is the growth pulse of the world at the moment. And that is, of course, China, of course, India, Brazil. They are growing at a rate of between 4.5% and 5.25% this calendar year. That takes most forecasts. S&P 500 earnings are linked to that. US economy is linked to that. But true, labour market improvements are still required in the world's largest economy.
Yeah, and we find out more, of course, on that on Friday's that all-important non-farm payrolls report. Looking if any number comes in above that 200,000 level, at least what the sort of economists are saying, then we see QE3 right off the table, and any significant weakness, and then we start talking about it again.
Exactly. Payrolls is the monthly number we all look at. There's a good reason for that. But the reality is the US economy has been improving. They're 4 years into this deleveraging process post the GFC. They're well ahead of other developed countries. It's not ideal. They should be above trend rate growth for that amount of stimulus. But the reality is it's been a great environment for earnings. And the S&P 500, Q1 returned the highest quarterly return since 2009. So we are seeing the earnings come through. We are seeing some benefits there, but we'd like to see more in the years ahead, of course.
George, we're just about, 30 minutes away from the all-important trade data out of Australia here. How significant will this be, given that surprise deficit we saw in January?
Yeah, never look at monthly numbers when it comes to Australian trade balance. Smooth it out. It is significant, should be a positive. The reality is always to reinforce, and this reinforces the earnings of Australian companies. Australia, small open economy, net energy, net resource, net soft commodity exporter. That is what we do. We are effectively a barometer of the world economy. The RBA of Australia knows that. The global cycle impacts the domestic cycle, and that is a variable none of us can touch. So it's important, but the reality is Australia very much depends on exporting to sustain its living, to sustain the earnings of the companies in Australia. It's not perfect, but that's the reality of the way our economy is. The unfortunate part of all of that is that bulk commodity prices, high-grade coking coal or iron ore, we are the largest exporters in the world. We are effectively, the prices are so much lower than a year ago, it's impacting the earnings there. So we are price takers in soft commodity and energy and bulk commodities. That is impacting our earnings locally with the weighting of those companies. But the reality is this is vital data to look at over a quarterly basis, not a month-to-month. And we do expect some retracement from the negative of last month. There's no doubt about that.
George, I want to get a couple of questions in very quickly, so to appreciate concise replies. What about asset allocation? You're overweight cash. The rationale there?
The rationale, Australia, you can get term deposit rates of 5.5%, very compelling. You get 0 in the US and in Europe. That is why that overweight persists. But we are looking to reallocate into more corporate bonds, and also allocate into equities. Equity valuations, no matter how you look at it, 1-year forward multiples, trailing price to book, earning yield, bond yield, they are cheap in Australia, they are cheap versus other developed countries, and that is what we're trying to reallocate going forward.
Thanks, George. Have a great day. George Boubouras there joining us from Melbourne.